Assalamualaikum. My group will present loan versus financing and the concept of time value of money. Let me introduce myself first. My name is Nur Husna binti Zakir Fauzi and my metric number 1192403.
Assalamualaikum and hi, my name is Nur Afika Izzati binti Muhammad Shuaimi, metric number 1192439.
Assalamualaikum and hi, my name is Hanis Nazira binti Nazrin. My metric number is 1192398.
Hi and Assalamualaikum. My name is Nur Ala binti Roslan. My matrix number is 1192393.
Before we get started to know more about loans and financing, let's gain some information about Malaysia Islamic finance. According to Moody's Investor Service, Malaysia remains the biggest Islamic finance market in Southeast Asia. Moody's says the industry market share of total financing stood at 35.6% as at the end of June, compared with 34.9% in 2019. The penetration of Islamic financing in Malaysia is high and still increasing. More importantly, the growing acceptance of Islamic financial products and service among the population will likely be sustainable due to the strong regulatory framework in expanding Islamic finance ecosystem that includes sukuk, takaful, and Sharia compliant funds. Let's jump to the differences between loans and financing. Loan is when a bank lends money to the consumers for a certain period, but as condition of the loan, the borrower will need to pay a certain amount of interest per month or per year. Loan also is known as conventional bank. The loan contract for conventional is called as loan facility agreement. While financing are the sharing of profit and loss and the prohibition of collection of interest by lenders and investors. Financing, also known as Islamic finance or Sharia compliance finance, that banking activities that adhere to Sharia Islamic law. Next, we want to differentiate the term that used in the loans, which is interest rate, and the term that used in the financing, which is profit rate. Okay, for your information, the contract of the loan is not based on an absolute value, which is sale price. The sooner the borrower can pay down the principal, the cheaper the amount of interest paid. Interest rates are influenced by the central bank's base rate. This base rate is the rate at which commercial banks have to borrow from the central bank. Interest rate can be fixed rate or based on a floating rate. For example, Kuala Lumpur Interbank Offered Rate and current base lending rate. This rate is so important to banking system. If the base rate goes up, commercial banks will invariably increase their saving and borrowing rates to the consumers. For financing, there is no provision to charge any extra money from the defaulters, only small amount of compensation. Rebates also are given for early settlement at the bank. Financing are Islamic banks. It makes a profit through equity participation, which requires a borrower to give the bank a share in their profits rather than paying interest. Like conventional bank, we have interest rate, but in financing, we have profit rates. Profit rates can be fixed rate or based on a floating rate, BFR, which means base financing rate, is the benchmark profit where bank used to price their financing product.
Next, I will differentiate between other factors that influence loans and financing. For loans, credit crunch can be difficult to attract sufficient funds, So, interbank lending is more difficult and expensive. Therefore, loan rates can rise even if base rates stay the same. But what is a credit crunch? I got you. A credit crunch is a sudden reduction in the general availability of loans or credit. A credit crunch generally involves a reduction in the availability of credit independent of a rise in official interest rates. Meanwhile, for financing, it promotes risk sharing between provider of capital, which is investor, and the user of funds, which is entrepreneur. Participation in partnership is a fundamental function, so they have to understand customers' business very well. Last but not least, I will give examples of situations to differentiate loans and financing. First example is for loans. Okay, if a person owes 10,000 ringgit on the credit card with a 6% interest rate and they pay 200 ringgit each month, it will take them 58 months or nearly 5 years to pay off the balance. However, with a 20% interest rate, the same balance and the same 200 ringgit monthly payments, it will take 108 months or 9 years to pay off the card. The second situation is for financing. For example, if you run a small business and you need 40,000 ringgit of financing, you can either take out a 40,000 ringgit bank loan at a 10% interest rate, or you can sell a 25% stake in your business to your neighbor for 40,000 ringgit. Suppose your business earns a 20,000 ringgit profit during the next year. If you took the bank loan, your interest expense, which is the cost of debt financing, would be 4,000 ringgit, leaving you with a 16,000 ringgit in profit. Conversely, if you use equity financing, you would have zero debt and as a result, no interest expense. But you would only keep 75% of your profit because the other 25% is being owned by your neighbor. Therefore, your personal profit would only be 15,000 ringgit or 75% multiplied by 20,000 ringgit.
Time value of money? TVM? Do you know what is TVM? What is time value of money? So let's proceed. We meet again. Okay, so what is TVM? The time value of money. The time value of money is a basic financial concept that holds the money in the present is worth more than the same sum of money to be received in the future. This is so true because money that you have right now can be invested and earn a return, thus creating a larger amount of money in the future. Also, with the future money, there is the additional risk that the money may never actually be received. For one reason or another, the time value of money is sometimes referred to as the net present value of money. Next, we proceed to the example of TVM. Now let's look at time value of money example. If you want to invest $100, which is the present value for 1 year at 5 interest rate, the discount rate, then at the end of the year, you will have $105, the future value. So according to this example, $100 today is worth $105 for a year from today.
Okay, first of all, the time value of money is an important concept not just for individuals but also in making business decisions. Companies consider the time value of money in making decisions about investing new product development, acquiring new business equipment or facilities, and also establishing the credit terms for the sale of their products or services. So, what is the formula of the time value of money? Here, let's check it out. A specific formula that can be used for calculating the future value of money so that it can be compared to the present value, which is FV equals to PV multiplied by 1 plus I over N, the power of N multiplied by T, where FV is the future value of money, PV is the present value, I is the interest rate or other return earned on the money, T is the number of years to take into consideration, and N is the number of compounding periods of interest per year. You have $5,000 and can expect to earn 5% interest on that sum each year for the next 2 years. Assuming the interest is compounded annually, what is the future value of money? From the question above, we can see that PV equals to 5,000, I equals to 5%, which is 0.05, N equals to 1, and T equals to 2. So, by using the future value of money's formula, we can get 5,000 multiplied by 1 plus 0.05 over 1, the power of 1 multiplied by 2, and the answer is $5,512.50.
So that's all for our video. Thank you and stay safe.
Hi, my name is Nur Alawi Roslan. Kita ada Assalamualaikum.
Hi and Assalamualaikum. My group will present
My metric number is 119231. Aduh,